Hey guys, so in the previous video, we covered some of the balance sheet assumptions and the balance sheet to the best of our ability given the data that we have at this juncture. So in this video, we are going to be building the cash flow statement. So let's just begin with that. Yeah. Take this here. Statement. Let's start with CFO, right? For I F, right? Okay. Let's start with PAT, depreciation, amortization, less change in NWC plus interest expense less interest income, right? And you will get CFO as a result of this. Let's just link everything, right? So for FY23, let's go to the P&L, link the PAT straight from here. Yep, and amort, go again back straight to this 5. Change in NWC, let's go with the balance sheet. So it will be previous year minus this year, right? Because if this were to go up, it's an asset, cash would go down. This 0. Interest income expense, we haven't computed yet. Let's leave that for the end, but we got to be very, very wary about the science, right? It's easy to get this wrong. It can just be this interest expense, right? So I've just done plus. Now let's just confirm that the sign is right. We've subtracted minus 39, so this will be positive. So yeah, that's fine. And then this will be nothing but interest income. It has to be minused, right? Because this will be a positive number that we are adding to the EBIT. We're adding G38. Yeah, that's correct. Just drag and drop this. Okay. Just sum this up. We have a CFO. Next, compute CFI, right? So what will we have in CFI? We will have capex. We will have interest income, which was the total CFI. What is in interest income? Nothing but interest on cash, right? So capex, what are the only type of capex that we have in this business? Maintenance capex, right? So let's just link it to this, but the sign is very important. Should be a negative number, correct? So we're adding back interest, right? So we subtracted it here, minus. This should be minus of this, minus of minus, which is plus this, nothing but this from these numbers. Next, we go to CFF. So we subtract interest expense here, right? After interest expense, we'll have change in debt, we'll have change in revolver, we will have an equity raise. If at all, we just need to provide for it. We'll have dividend paid, right? And this will give us our CFF. This will come from the debt schedule. Let's go line by line actually. So interest expense, this is a positive number. So this will have to be a number, right? So minus of this. Change in debt coming from debt schedule, change in revolver coming from debt schedule. Equity raise. So we've not been told anything about equity raise. Let's just assume it's going to be 0. because let's assume if we need additional capital, it'll come through revolver debt. So this is 0. Dividend paid again is going to come, is going to come from the cash flow statement from debt schedule. Sum these up, right? So we have CF4 now, we have CFI, and the only thing left is certain elements of CFF. So here, beginning cash plus change in cash, right? So what is the ending cash for FY22? 0. Assume this pulled from here, previous amount. Change in cash is going to be nothing but CF4 plus CFI plus CF. Yep. And ending cash will be nothing but A plus B, right? As of now. So let's just assume interest rate on cash. Let's just assume the interest rate on cash is, I don't know, 3%. So let's just actually copy paste this. Interest income will be, so now if we compute interest income, there's going to be a circ reference, right? Because this is going to go into the P&L, which comes all the way down to the cash flow and is input is linked to the output and vice versa, right? So we got to provide for a circ. So let's just call this circ. Let's just say list 0.1. Right. Let's just name this cell circ over here so we can use it throughout the model without having to what is that cell. Let's just say if circ is equal to 0, 0 else average of this balance starting and ending balance times my interest rate, right? So now we've computed the cash flow statement. Again, basis whatever we've done so far, and in the next video we are going to build the debt schedule. So one thing I want you to notice is, remember, right, what did they tell us at the start? They were like, all excess cash generated by this business has to be taken out in terms of dividends. Now, right now it seems like the business is generating cash and we've not factored in dividends. Yes, because of that, a lot of cash is accruing on the balance sheet. That's not going to be the case. We are going to make this adjustment in the next video. So see you guys in the next video.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.